The return to risk on this trade is 1.5 to 1 and already starting in the profit. And on this trade, here's another small account trade that's a very likely winner. Hey, what's going on, guys? In this video, I'm going to give you two unbelievable small account trades that will 1.5x your portfolio fairly safely with a large reward to risk ratio. Now, I'm going to be using QQQ for today's examples, but you can do these examples on any stock and at any time because they're still going to be profitable as long as the market is in a volatile place and as long as you're kind of bearish on the stock that you're going to pick. With that being said, make sure that you stick through both of these strategies as I'm going to explain how to open, manage, and close these trades. And last but not least, I do appreciate you liking the video. It helps me out tremendously and I know to keep making these videos for you. All right, so let's talk about this first trade. It's kind of complicated, so I'm going to open it up from scratch, okay? So using Robinhood, I'm going to go to QQQ. Now the reason why I want to pick QQQ is because tech stocks are more volatile than the S&P 500 and I want to make this trade on an index. And using QQQ gives me exposure into some of the biggest technology companies like Apple, Microsoft, Amazon, Tesla, two different types of Google shares, Meta, Nvidia, and some others. So I'm going to trade QQQ options. Now, what I'm going to do is I'm going to go out pretty short term, but also kind of medium term, up to November 4th. Now, this is going to be roughly a week out, but again, remember, you can use this strategy in the future. As long as you go out between 1 to 2 weeks, this is a pretty interesting trade because this trade really benefits in the short term from the stock falling. So when the stock falls, you can turn a little bit of money into a lot bigger amounts of money and the stock doesn't actually have to move that much. Now, the first thing that I'm going to do is I'm going to buy the 281 call option. This is going to function as my base. So if I go to buy 281, I'm going to buy this. Now, this is my base, and now I'm going to open up two different call options, except this time they're going to be two different sell orders. One of them is going to be the 278 and the 283, and I'm going to tell you exactly why. So first of all, I'm going to go ahead and sell the 278, and it looks like QQQ is falling right now as I make this video, so I can actually sell the 277. The reason why I want to do this is I want to pick a slightly in the money call option to sell. This is going to function as my bear case, where this option is going to make a lot of money if the stock moves in a bearish scenario. Now, what I'm going to do is I'm actually going to now sell at 283, and this just kind of adds to my bearishness in my portfolio, but it's going to balance out as I'm going to show you, because when I go here to the custom order, I'm going to create a custom ratio, and what I'm going to do is because there's a sell order and a sell order, I want to make sure there's a buy order for every sell order. Now quickly, the reason why you can't have two sell orders and one buy order is because you would be exposed to unlimited downside. Since only one of these call options is protecting you, and you have two sells, then if the stock were to rise a lot, you would actually end up losing potentially an unlimited amount of money, which I don't want to have you in that position. So instead, I'm going to put a 2 ratio. So 2 and then 1, 1. So basically, the ratio is even and balanced now, okay? This right here is functioning as my base, and this 283 is actually functioning for me to get some premium, but really the bearishness and most of that reward is coming from this 277 call. So long as this goes below the 277 call, then I'm going to end up making really good money. As you can see right here, it's 278 is my break even. And the reason for that is because I'm actually collecting about $105. I'm actually starting off with the credit on this position. So if this stock were to go down to 277, which is my call option strike right here, it's going to give me the maximum amount of profit, which is going to be the amount that I'm collecting, roughly $100. So this is really good because if QQQ falls, and that is kind of likely given all the earnings, and since Google just reported some not so good earnings and it's down as the market just opened, then my view is that QQQ can probably fall a little bit further. Again, you don't have to do this on QQQ. You can literally open up the same position. This is actually called a broken wing butterfly. You can open up this broken wing butterfly on any position which you are kind of bearish on. You're always going to have a base. For here it's 281. That's going to be the very, very bottom point. Now, one of the biggest benefits of having a broken wing butterfly is, yeah, you can lose the maximum here of 285. However, that's not really likely unless it actually ends exactly at this point. So what's going to happen in a volatile market, because VIX is high, let me show you, the VIX is 28.5 right now. Since the volatility is high, what's going to happen is either QQQ is going to fall, which I hope it does, right? And I would make some money here, or the stock that you're trading doesn't have to be QQQ, will go up a lot, right? And then you would lose some money, but you would only lose $85 here. So the risk to reward ratio is actually still pretty good because you are collecting a credit, and actually you're collecting a credit and you can make up to $115, but your downside is only $85. So your risk to return is pretty favorable here. Now your max drawdown is kind of large, but that is unlikely to happen unless the stock were to end at exactly $281 per share. So when there's high volatility, this is pretty good because, for example, it's not likely to stay here. It's likely to either crash down, which would be good for you, or if it just rises a lot, that's fine as well. You can actually end up closing this option early, or you could just hold and, obviously you would experience a loss. But more often than not, your expected value would be positive. But you can also close out this position earlier. And for me, I would close out this position earlier if the stock were to experience a tremendous upside move. So if it did end up moving somewhere around this area, I would look to close this position and probably experience a small loss. Now remember, money won is twice as sweet as money earned. And when you do have to close out a position for a small loss, that just happens. It's part of trading. Just keep in mind, if there wasn't any luck involved, then I would just win every trade every time. But because the market is volatile and it's impossible to win 100% of trades, what I'm going to do is I would close this position if it goes against me. I would admit that I'm wrong and I would just move on. But for me, the risk-reward ratio looks attractive here. And if you're semi-bearish on a stock, this would be a fantastic strategy to deploy for a small portfolio. Now, the second trade that I want to show you is going to be kind of similar, except it's not a broken wing butterfly. This trade also benefits when the stock falls, so this is a bearish strategy to grow a small portfolio quickly in a bear market like right now. This strategy is actually easier to deploy because it's only going to involve two different options. Now, the first option that I'm going to purchase is going to be a buy put option. I'm still going to go for November 4th, which is a week out, but you can do this strategy anytime. Just go 1 to 2 weeks out for a short-term play. So I'm going to go buy put option, and then I'm going to pick actually an in-the-money put option. This is a little bit strange because I haven't taught this before. However, by buying an in-the-money put option, this is going to have a high delta. So let me expand this option right here to 281. So notice right here that this delta is above 50%. It's 0.53. So there's a 53% chance that this option is going to expire in the money. That's pretty good because if I'm buying an option, I don't like to buy out of the money options as they do expire and you end up losing money. But here I'm buying an in-the-money option, the 281, okay, the delta is 0.53. The implied volatility isn't that high, but again, this is an index fund. So actually, because it holds so many tech stocks within it, it could fall a lot, but the implied volatility isn't that high because it has so many components within this index fund. For me, that's actually really attractive because, for example, Google is down today, as you can see, and this index is down 1.86. In fact, this option right here increased by 39% in value. So tell me, the implied volatility isn't that high. However, these options move a lot. They're very lucrative to trade, especially for small portfolios, because this trade right here is only going to be a couple $100. And on a couple $100, you can actually have a return of a couple $100. So the return potential is insanely high for growing a small portfolio. Now, so I'm going to buy a put option, 281. We have a delta of 0.52, and the volume is 47, which isn't actually that high, but it's also not bad. 47 is just fine. So now what I'm going to do is I'm going to go sell a put option. Now, this put option I bought in the money, the one that I'm going to sell is going to be slightly out of the money. So 281, I'm going to go down by about $300, or a difference in strike of 3, and I'm going to end up selling a put option for the 278. So now, as you will notice, this is a put debit spread. However, there's an interesting scenario here. It's actually in the money slightly. It's slightly in the money, and that's why the max profit here is a little bit higher than the max loss. However, what I actually want to do is, because this isn't that much of a difference, I'm actually going to go down a little bit further. I'm going to go down to about 276. That would be a $500 spread. And now you can see that the maximum profit is actually a little bit higher than the maximum loss. This is actually more significant. So the risk to reward ratio here is pretty positive. But the interesting part about this put debit spread is that it's already in the money. and it already has an intrinsic value of about $220 intrinsic value so far. And as the stock moves lower, this put debit spread is going to increase in value. So say that the index falls down by about 1%, you're going to start increasing in value by a whole lot more. So as an example, you can see that this ticker is down about 2%. However, these options are up by 38% and this one is up by 41%. So the difference currently is almost 3.5%, 4%, looks like 43.5, and then this is about 40, so about 3.5%. So as the stock moves down by about 1%, you're having a 1.5 times leverage. So you're actually making 1.5 times more, and you're only using a small amount of capital here. So this is a very attractive position for a small portfolio. And basically, this is how I would manage the position. I would wait until it comes closer to November 4th or my expiration date, whenever that is. As it approaches expiration, as long as the stock is moving in the wrong direction, which is down, and as long as the stock is moving lower, which would be the good direction for us, because as it moves lower, we make money, I would keep this position in place. Now, if this position were to go in the opposite direction, I would keep holding for a few days, but as it approaches November 4th, it's becoming more dangerous to hold because time decay is really going to start kicking in, and because you're actually long options here, you're buying options, these options are going to start decaying, and this more expensive option that you're buying is going to decay more than this less expensive option that you are selling. For that reason, you would want to get out a couple days before expiration. Remember, these two strategies right here are fantastic for small portfolios. It's actually unbelievable how much you can grow a small portfolio by using them, and both of them have very favorable and attractive risk to reward ratios. If you want to see another video about broken butterflies, then make sure to check out my small option playlist right here.